and welcome. You're watching Business Today TV. I'm Sakshi Batra, and this is BTS, that's Behind the Scenes, a show where we share a sneak peek into the latest edition of the Business Today magazine with all our viewers. And joining me on this edition now are Anand Adhikari, Managing Editor of Business Today magazine. Also joining in is Binu Paul, Senior Assistant Editor. Joining us also is Ashish Rukhaiyar, Senior Associate Editor of the Business Today magazine. And now, to showcase the first glimpse of this cover issue, for all of our viewers right here. You can actually see Gautam Adani right here on the cover. And it's all about making of Adani 2.0. And Anand has really covered this pretty extensively. Anand, welcome to the show. So let me kick start off this discussion with you itself. Of course, this year has been pretty tumultuous for the entire Adani group, the shareholders, the investors at large, and everybody from the policymakers to the legal, everybody has been involved with this issue in the first 6 months of this calendar year. Now, what 6 months after Hindenburg report, how is the Adani Group managing to really find a balance between growth, capex, and deleveraging its debt is something that all the investors would want to know.
Thank you, Sakshi. So, firstly, I will just start with some big numbers. Now, if you look at the entire the gross debt of the Adani Group is around 2.2 lakh crore. Revenues are 2.6 lakh crore. So revenues are much higher than the debt. Now, if you look at the assets, the total assets of the group is around 4.2 lakh crore. So 2.2 lakh crore debt, 4.2 lakh crore total assets. So assets are almost close to two times of the debt. Now the leverage ratio, I mean, that's the use of the corporates which they do in the business. Now leverage ratio has gone down. The net debt to EBITDA, from 3.81 in FY22 to around 3.27 in FY23. Now let's see the free cash flow. I mean, the group on a turnover of 2.6 lakh crore, they earn net profits of around 25 lakh crore. Now, if you look at the free cash flow, they're around 80,000 crore. Now, the group says that this money is enough to take care of any repayment that will come in the coming year. And I also got an opportunity to meet the group CFO Robbie Singh, and he was telling me that by 2025, the free cash flow plus the cash balance, which is currently is 80,000 crore, by 2025 this will be greater than any debt maturity which will come post that. So he was telling me that they will be in a much comfortable position post 2025. Now what else we have seen, let's say in the last 6 months, the post Hindenburg, promoters have also sold equity. So promoters have sold almost 2.87 billion US dollar to GQG partners, the global private equity firm. Now that equity will also in a way come back to promoter into the businesses. Plus there are three Adani companies. They are planning equity raising of around 4 billion in the next 12 months. So a lot of equity that will come into the business in the coming year, and accordingly they will raise debt also. Other thing is about the the focus of the group, and group clearly says that they will focus on infra plus the exigencies. So you must have seen in the last 2 weeks they got out from financial services business. So in a way they are getting out from the non-core part to preserve liquidity for the future growth. So that's the big change we are seeing in the group in the last 6 months. Another thing, when I met Robbie Singh, and he was telling me, the group invest. He was telling me for an intergenerational period, and the other quote which he gave me, and he was telling me they have not even completed the foundation of their growth. So you can see, I mean, they are here for a long haul.
Absolutely, and very, very interesting points to note right there, Anand. But just delving a little deeper, barring say the group companies Adani Total and Adani Transmission, all the other Adani stocks have actually seen a recovery in the stock markets from the lows that they had hit after the Hindenburg research report. What could be the reasons of the underperformance of these two specific stocks and the companies?
Yes, so Adani Total and Adani Transmission, the way I look at it, people had a lot of expectation, on these two, from these two companies. So let's look at Total Gas. Now, Total Gas is into, city gas distribution. And if I look at the IGL, the Indraprastha gas, or let's say the Mahanagar gas, they get a PE of around 10 to 20 times, whereas Total get a PE of more than 120 plus. So people had a lot of expectation from the company on the Total side, on the scaling up of the business. But the other big change which I noticed in the last 6 7 months is about the new administered pricing which the government has introduced. Now the gas prices will be linked to the crude oil prices. So let's say tomorrow if the international gas prices go up, and they won't be able to increase the prices to that extent, so there will be some impact on the margin side. So people, the investors are a bit skeptical, because if tomorrow, because of these administered prices, there will be some impact on the margin side. Now, if you look at the new businesses which they are building, e-mobility and the biogas and all that, they are very small businesses. Maybe that must be the reason, why the Total is not performing or not recovered the way other stocks have recovered. Now, Adani Transmission, which now they are calling Adani Energy Solutions in business. Now, apart from the transmission, they are getting into the distribution side and also the smart metering. Now, again, these two businesses are high margin business, but they are again very small. So, and there's a high debt also in the Adani Transmission. And if I see the leverage, the net debt to EBITDA is like 4.55 x. So leverage is also high. So I believe that must be the reason why these two stocks are in a way underperforming
Okay.
relatively as
Oh,
compared to the other Adani companies.
right. But Anand, very quickly, I also wanted to understand, you've also done an exclusive interaction with GQG partners Rajiv Jain, and things started to change right after their investment. Now, despite the huge correction in Adani stocks, none of the mutual funds or the institutional investors bought Adani Group companies. Tell us why Rajiv Jain was so bullish. What gave him the confidence?
I had a very detailed interview with Mr. Jain, and he has a word of advice for Adanis, and he was saying, don't deleverage, too much, go full throttle. I mean, that's what he is saying. So you can imagine, how bullish is, GQG partners, on the Adani Group companies. Now, in a way, GQG is playing the India infra game, via the Adani Group companies. Now let's look at one or two companies where the GQG has invested. Now Adani Enterprises, if you see, I mean, they have the biggest bet here. I think they have invested almost 6 to 7%. And Mr. Jain was saying, if you look at the hit rate of Adani Enterprises, because they have incubated all the other Adani companies like Adani Wilmar, which came out with the IPO recently, and you must have seen, the kind of return Adani, Wilmar has given. Uh, Adani Enterprises is incubating airport business, and then you have a roads business, then you have a data center business, then you have a green hydrogen business. Now, tomorrow, imagine if these four businesses will come out, you know, unlocking will happen, let's say, in these four businesses. There's a huge upside that going to come on the Adani Enterprise. I mean, that's what he's saying. So he's betting big on Adani Enterprises. Now, Adani Green. Currently, they have a this total capacity around 8.1 gigabyte, and they're adding 3 gigabyte every year. So last year they added 3 gigabyte. Even this year, despite Hindenburg, despite all the issues which people talked about, they're going to add 3 gigabyte in current year also. And the total target they have is around 45 gigawatt by 2030. So again, he sees a big upside there, and they are recycling a lot of equity. Whatever EBITDA or the cash they're getting is coming back in the business, and they're going to expand. So tomorrow you will see a big upside in the ROE on the Adani Green side. And ports, we have seen recently, they have acquired a Israeli port. They already have a portfolio of 14 ports, and Mr. Jan was telling me that currently Adani port gets the price to money of around 15 times, and he has seen Chinese port some years back getting 30 times plus. So he's very bullish on the port business also. So overall, he's playing the infra bet via the Adani Group here in India.
Absolutely, Anand. Well, this discussion can actually prolong because this is, of course, one of the biggest corporate interest stories of this year. But from the large and the mid cap companies, now let's shift focus to the small cap segment as well, especially because the small cap segment is showing a lot of action in the stock markets, especially when we talk about the mutual fund side of it, the small cap funds. In the month of July, we've actually seen small cap funds seeing record flows coming in. And Ashish has done a very interesting story right here. Ashish, help our viewers understand, why investors are appearing so bullish on this segment, and could you elaborate more on what's really happening in the small cap space?
So thank you, Sakshi, for having me on this show. Now, if we go by data and numbers, then certainly small cap, and more specifically the small cap fund segment, is in the midst of a very interesting time. So let's just dissect it and look at these numbers one by one. If you only look at the stock markets, then in the current calendar year, that is 2023, the benchmark Sensex is up around 9%, while the small cap index, which is the barometer of the small cap universe, it's up around 22%. So clearly there's a huge outperformance between the small cap and the benchmark Sensex. And even if you look at the small cap fund category as a category of funds, then the average category return in 2023 has been around 15%, which is again much more higher than all other category of equity oriented schemes, whether you take large cap, mid cap, flexi cap, multi cap. I mean, given the if you look at the popular category of equity oriented schemes, so even in the mutual fund segment, this category of small cap funds has seen a large outperformance compared to other category of funds. If you look at this segment from a pure net flows point of view, then small cap funds in the current calendar year has received around 18,000 crore in 2023, starting between January and June. And this again 18,000 crore again is significantly higher than all other category of equity funds in terms of the net flows in this year. So whether it is stock market performance, whether it is the small cap category returns, or small or flows in the small cap segment, on all these parameters, there's a lot of traction in the small cap universe, and it clearly shows that there's a lot of investor interest in this segment, and a lot of investor appetite, and a lot of investors are looking at small cap as for from an investment point of view in the current during the current rally.
Right, Ashish, understood that. But if you could also help us understand that, while record money is pouring in, fund managers appear wary of investing in this segment. Why is that really happening, and what's the outlook on this space then?
Exactly, Sakshi. I mean, the flows, the record flows, or the outperformance is just shows one side of the picture, and the other side of the picture, there's a huge contradiction. Because if you see, many of the fund managers, especially those who are managing small cap funds, are very skeptical of investing or deploying more money in the markets as of now. If you see, there are two leading fund houses, Nippon India Mutual Fund and Tata Mutual Fund, who have small cap schemes, and both have decided not to take fresh lump sum investment in the schemes. Now, this assumes a lot of significance because Nippon India Mutual Fund has the largest small cap fund in the country. Its small cap fund AUM is around 32,000 crore, which is quite large. The Tata Mutual Fund small cap fund is also the AUM is around 5,500 crore. And when we speak to fund houses, a lot of people have said that they had plans to launch small cap funds, but they have rolled back their plans of launching a small cap fund given what is happening in the market. Now, what exactly has made these fund managers skeptical? It's a combination of factors. The first and the biggest reason is the huge run up in stock prices. We all know what is happening in the stock prices, and we also elaborated on how on how small cap as a segment has outperformed the benchmarks. So clearly, there's a huge run up in stock prices of most of the small cap stocks. Thereby, there are concerns related to valuations. Liquidity is a big issue in the small cap space, because see, unlike a very large cap company, the free float in a small cap fund is not that broad, is not that huge. And when these fund houses want to deploy money, they deploy money in huge quantum. So obviously sometimes they don't get the right quantity or the desired quantity of shares at the right price. So deployment has become a big issue. So what these fund managers are saying, that if we are getting, because as we elaborated, the flows are at record high. So if they are getting that much of money, and if they are not able to deploy, then they have to maintain cash, and maintaining cash negatively affects the NAV, because cash is not going to get you those returns. So that's the reason. Because of combination of these factors, run up in stock prices, valuation concerns, liquidity and deployment issues, These are, I mean, a combination of these factors have made fund managers very skeptical of deploying more money in the small cap in at the current juncture. But having said that, if you talk to them, if you ask them the outlook, they believe that while there is some amount of euphoria in the small cap space, the long term outlook, they are still very bullish, because they feel that there will always be good opportunities or good attractive investment opportunities coming their way, and the ongoing pause in terms of taking fresh lump sum investments is only temporary in nature.
Absolutely. Well, that's of course very insightful when it comes to all the stock market investors right there. But let's now shift focus and shift gear to something that impacts us on an everyday basis while you daily take that ride to your office and to your workplaces. And that's the ride hailing industry. And Binu Paul has covered that industry very, very extensively on an everyday basis. He looks at the issues being faced and the changes being implemented in this industry to make it more vibrant, more accessible, both for the consumers and the operators right there. Binu, what's happening here really currently? We did see a lot of problems during the COVID pandemic. So, how bad was the pandemic's impact on the ride hailing sector? And how has the market now revived? Because most of the offices, including the tech sector, are now pushing the employees to come back to offices. So I'm sure that the demand is picking up. But what's the sense you're getting on ground?
Right. Thank you, Sakshi. So you're right. The pandemic had a huge impact on the ride-hailing business, and if you were to look at pre 2022, it was an absolute duopoly in the ride-hailing market. So users couldn't think of a third option outside Uber and Ola. But both of them were doing around 1.5 million rides a day. But things changed with COVID. At some point, the business went to zero. There was no rides at all. But as with many other pandemic hit sectors, ride hailing also came back to its pre-COVID levels. Things were the ride numbers also got back to the level they were doing before, 1.5 million or 15 lakhs rides a day. But two distinctive changes have taken place because of COVID and its impact. Firstly, the number of cabs or vehicles on these platforms have reduced significantly because a lot of drivers were forced to leave the profession altogether because there was no demand, and they sold off the cars and many of them went back to their native. So, and a lot of them did not come back. So in Bangalore alone, if you were to look at pre-COVID, there used to be around 1 lakh cabs on the road, and right now it is down to 40,000 or even lesser, is what industry observers are saying. So that huge, massive supply crunch has kind of resulted in significant delay in decline in service quality overall. And so you can see customer complaints of badly maintained cabs, frequent cancellations, long waiting hours, to get a cab. So these things have become so common after the pandemic. Plus, ride costs also have gone up. As per people in the industry, they say the cost have gone at least 1.5x, before compared to pre-COVID phases. Now, the second change is that both Ola and Uber saw an opportunity during this crisis. They slashed down all the driver incentives, user discounts, and the commissions. While the commissions and ride costs remained high, so this has actually helped them to kind of reach profitability in the core ride hailing business, and that is a very significant phase for these companies who've been here for at least 10
Absolutely.
years now.
Absolutely. And you know what, Binu? Now that the things have changed post COVID, demand is back. A lot of previous issues are being already tackled by these duopoly majors, Ola and Uber. What's also interesting is that newer players are entering the market as well, trying to disrupt this duopoly too. I'm talking about the electric cabs that are now making inroads right there. Tell us more about it, and what does the future really look like for the ride hailing industry now?
You're absolutely right, Sakshi. So I did speak about how companies are now focusing on profitability. Now, if you look at it, the other side of this profitability focused strategy is a very lean and mean operating structure that both these companies are kind of following now. Both of them have moved away from the cash burning initiatives that they used to run, and Now, as of now, it looks like, the cab hailing business of both Ola and Uber are kind of in an autopilot mode, where they don't really have to invest so much or make so many new initiatives to run it. Now, what has happened, because they've moved on to a focus, profit oriented initiative, and a host of new players are kind of smelling an opportunity here. So, and they're all coming to the market with certain differentiated strategies, offerings which the existing duopoly players, the leaders, couldn't address. For example, Blue Smart, they've positioned themselves as a premium, reliable alternative to Uber and Ola. They offer fixed prices, scheduled rides, so that kind of addresses the surge pricing and cancellations. And they also have the cost advantage because they have an all electric fleet. Another example that I can mention is InDrive, which is a global company which claims to be offering operating in 40 odd countries. They're now operating active in 12 cities in India, and they offer an auction based strategy for users and drivers to kind of negotiate prices, and they also charge a much lesser commission, just about 10%, as against the 30% commission of Ola and Uber. There's another company called Drive, which works on a subscription model, wherein drivers pay this company a small amount rather than paying a commission. Now, if you look at, on the other hand, a lot of people are moving to three wheelers, auto rickshaws as an option, because cabs have become very unreasonable in pricing, and the quality of services have gone down. So, Rapido is a big player there. They're in 35 cities now. They're already the second player in the auto section in many of the cities. Namayatri, which works on the ONDC network, they've gotten at least to 20-25% of market share in the city in less than 7 months. So ride hailing, unless other top consumer internet segments, is actually turning into a very unique position where the market is actually opening up for more players from being an absolute duopolistic phase, and that's a stage for a very interesting phase of growth.
All right, then. Well, many, many thanks, Binu, Ashish, and Anand, for sharing all these wonderful insights from the latest edition of the Business Today magazine. There's a lot to take in for all the viewers right there. In case you're interested in the big corporate developments, especially the Adani Group, then there's a lot for you to really understand as to what is happening with one of the largest conglomerates in India. Also, of course, if you're a stock market investor, if there are opportunities for you in the small cap segment, do look at the article by Ashish Rukhaiyar right there. And of course, consumer interest right there for the ride hailing space, and much, much more. We also have an interview with Nick Clegg of Meta right there, so don't forget to read that too in this edition as well. And with that, we wrap up this edition, but do stay tuned on to Business Today TV for a whole lot more action coming up right up on your screens.